Hello everybody, Kevin Shortell here once again. I've got another great case study for you. This one has a lot of lessons within it. The first one is having backup plans. Always important when you're investing in these assets, much like real estate, you have a plan A, B, C, and D. You've got to have multiple exit strategies all prepared. In fact, if you can effectively examine each one of those exit strategies to the point where you're making a profit no matter which way it goes, well, you have effectively eliminated or lowered, I should say, your overall risk. In addition to that, this case study shows how many of the students that we train at higher levels, they take non-performing notes and get them re-performing, keeping people in their homes. Once they've done that, they've added value to that note and they can turn around and sell that note. And that's exactly what happened in this case study. So let's jump right into it. This was an asset that was in Florida. In fact, it was in the Gulf Coast of Florida, very nice area in Florida. And it was a non-performing loan. The BPO in the property was just under $127,000, as you can see. It was about 1,100 square feet, a 2-bedroom, 1-bath, and it was an occupied property. Well, this original loan for the borrowers was $107,000, and it was written at 6.6% for 30 years, and you can see the monthly payments there are $683 per month. And these people were successful making payments. In fact, they've made 123 payments on this note before something changed in their life. Something happened financially where they simply were not able to make these payments, and then they were in limbo land. Right? Various banks were trading papers, sending them letters and everything else, but they didn't have anybody who would take the time to work with them, so they were stuck. In fact, that went on for 5 years. After successfully making 123 payments, they stopped making payments for 5 years. And again, being in that limbo position, they didn't know what to do. Where do we send our payments? And if we do make the payments, does that stop the foreclosure action that's been posted on the property? And of course, they knew the answer was no. So they were looking for somebody to work with them and help them out of this situation. Well, luckily, along came our students and they purchased this loan. They purchased it obviously at a discount. In fact, here's what the note looked like as they purchased it, right? The original loan was $107,000. These folks, through making those payments, had brought that unpaid balance down now to $79,371, and they have cut the payment term down from 360 months down to 237 months. That's when our students came along and purchased this non-performing asset. And of course, they purchased that at a discount. In fact, the price on this one was $32,000 for that note. Now remember, the unpaid balance is $79,000. The house is worth over $100,000, and they were able to purchase this non-performing note for $32,000. Now, there were also, in addition to this, $800 in unpaid property taxes. And unpaid property taxes, that is something that you obviously identify before you purchase that asset, and you know what the cost to cure is. In fact, in this case, the cost to cure, pretty simple. You would pay the $800. Now, you'll find as we progress through this example that our students didn't pay that. The property owner ended up paying that because they wanted to stay in the property. So the first step there was, let's lay out our overall plan. What do we want to accomplish? And they realized, well, first of all, it shows that the owner wants to stay. They have what we call emotional equity. If you remember in the picture, there was a boat right next to the property. They were taking care of the property even though they weren't making their mortgage payments. Being in Florida, one of their first thoughts was, well, perhaps they can qualify for hardest hit funds. But again, you never go into this going, oh, they're totally going to qualify for that, and that's the way it's going to go. Nope, you can't do that. You can say, that's my plan A, that's what I'm going to go for, but if that doesn't work out, what's my next move? And the next move in this case was to do a loan modification. And in fact, they wanted to do that loan mod to get this note reworking, and then they could turn around and sell that as a reperforming note. So that was the sub-plan to their second plan here, which was the loan modification. They figured if they couldn't get the loan modification, they would let the people off of the debt, relieve them of their debt obligation by offering them a deed in lieu of foreclosures. And so in this case, the borrower who's living in the property would sign the deed over in lieu of foreclosure, and the note holders would end up saying, okay, we'll forgive and accept that deed in lieu for 100% of value. If we can't get that done, we'll do a foreclosure. And they also knew in foreclosure that they can go ahead and get an assignment of foreclosure from the last note holder. Okay, there's no guarantee in that, but it's something that you want to absolutely pursue because in Florida we have a judicial foreclosure process. And in a judicial foreclosure process, it can take a longer period of time. In fact, up to about 12 months in Florida. If you get an assignment of foreclosure, you can jump right into the foreclosure process where the last party left off. And that was their overall plan and approach. So they pursued this. They purchased the note, understanding it had some property taxes that needed to be resolved. But the first thing was, let's open the communication with these folks. Let's see if they really want to stay. Let's see if they have the ability. Perhaps they lost a job 5 years ago. That caused a financial hardship, and now they're working again, and they can afford to make the payment. So the doors of communication were opened. They had their servicing and workout company contact these folks. These folks were excited to learn that they are working with somebody who will allow them to stay in their home if they can't afford to do so. So they immediately filled out the hardest hit fund paperwork. And for whatever reasons, and I don't know what they are, it doesn't matter, hardest hit funds didn't work out. They weren't approved in this particular case. And again, that's why you can't just have one plan. So they went to the next plan was, okay, we can't do hardest hit funds. Can we do a modification with you? And they had their servicing and workout company work with these folks to make sure to establish the fact that they can afford these monthly payments. And that was looking very good. That was looking very strong. In fact, they were able to modify this loan. And here's what they did. First of all, to modify the loan, you all, the borrowers, the property owner, you have to pay up the property taxes, or $800. And they agreed to do that. Secondly, we're going to forgive a lot of this arrearage account. And again, the arrearage account is all the past due payments and penalties and interest that's accrued over those 5 years. We're going to forgive the majority of that, but as an act of good faith, we're going to have you pay $6,400 of that arrearage account. We'll forgive the rest. You do that, and then we'll modify the loan. And they agreed upon the terms of the loan. We're going to make the loan $80,000 at 7% for 240 months. So they tweak the existing loan as they bought it, simply elevating the interest rate a tiny bit, modifying the term just a tiny bit, and the balance became $80,000. For that. So just some minor tweaks on that, obviously keeping in mind that they want to make sure that these folks can afford to make those payments because they did want to stay. So this is what that loan would look like, $80,000, 7%, 240 months, and their payments were $620 a month now. So they collected 3 of those payments. In other words, the borrower successfully made 3 payments, and you can see the total right there. Once they had that note they had that note seasoned, okay, seasoning's the payment history, they seasoned it for 3 months. And they had another investor that was interested in buying notes, so they sold this note as a reperforming note. Okay, so they sold it for $59,500. Unpaid balance was still just about $80,000, obviously, when they sold that, and it's all backed by what? A house that's worth over $100,000. So good deal for the person who bought the reperforming note as well, but also a good deal for these particular students, because when you think about what they did, they started with an investment of $32,000 to buy the non-performing note. They were able to work out a modification. The modification meant that the borrowers were going to pay them $6,400 up front, in addition to paying the property taxes, right? And they received $1,860 in the 3 monthly payments. And then they turned around and sold that as a reperforming note to another investor for $59,500. Some quick math on that, $35,750 profit. They had some incidental expenses in there, for workout companies and servicing, but the raw numbers of this deal, they invested in the note, they got it reperforming, and they ended up selling this. All parties were happy. The homeowner got to stay in their property. A lot of their debt was forgiven. They were motivated, they were incentivized, if you will, to continue to make those payments. So it was a great deal for them. Obviously, our students were happy. They took a $32,000 investment and made a $35,000 profit on that, which is a huge, obviously, return. And guess what? The person who bought the reperforming note is making a good return on their investment as well. So always go into these deals with multiple exit strategies so you're comfortable no matter which way it goes that you're going to end up making money on the transaction that minimizes your risk. And then you start to think in terms of using multiple strategies to make a higher return than just an average note buyer would ever make. Look forward to talking to you again in our next video blog.